Four of the most renowned investors within the last century repeatedly bought stock shares during periods when major market indexes were falling to real lows. They often found their best bargains during periods of market correction. We can look at several fundamental principles they had in common, which led to their great success. As we've seen this year, the stock market reacts to news investors perceive either positive or negative for any variety of reasons. I fully admit that it is intimidating investing into a volatile market. However, my temperament is key to finding bargains in slumping markets. Perhaps the greatest of disciplined investor was Benjamin Graham, the father of value investing. British born but moving to America with his family at age 1, Graham taught that the starting point to a good financial future begins by spending less than you earn. After building adequate cash resources, you then must learn to invest conservatively, as if you would live only on your portfolio income if you lost your job. Graham invested in stocks at a discount to tangible value, adding margin of safety to his investments. Discounted tangible value means finding good companies whose stock is selling at less than the breakup value of the company. By doing this, you pay less for a share of stock than it would be worth at the company's liquidation from a worst-case scenario. Equally important is that the company be fundamentally sound, although possibly facing headwaters management can steer around. Warren Buffett, a well-known disciple of Graham, would add that investors should study companies more than study investing. Through studying the business, real worth surfaces. Real worth is the true value of the company's net assets when liquidated, and this is the margin of safety you want to own. He also likes to acquire stock in dividend-paying companies, rarely holding shares in non-dividend businesses. Irving Kahn, another Benjamin Graham adherent, actively invested in stocks up to his death at age 109 in 2015. Kahn's focus was on seasoned companies in well-established business sectors whose shares were deeply discounted. Here again, the great investors consistently hold discounted stocks in good companies. Kahn went on to underscore the primary goal of investing, which is the compounding of capital or investor money over time. The principle of compounding is quite effective when applied to good dividend stocks and is extremely effective when buying assets on sale. Often identifying struggling companies in his favorite sectors, Irving Kahn always gave himself a healthy margin of safety, buying shares at discount to a company's true value. He was also keen on knowing company management, since sound management running a struggling company will create value in the stock shares. Similar to Kahn, Walter Schloss was another Graham pair who favored buying stocks at considerably less than their value to a private owner. With Schloss, the same discount fundamental appears again: buy good company stock cheap and enjoy the ride up. Schloss liked the idea of company paid dividends. He knew dividends made management more aware of stockholders' interests, which is still true with dividend paying companies. Schloss' optimal margin of safety was a company with real assets and little or no debt, removing goodwill from the equation. Buying discounted shares, staying risk-averse, and largely ignoring market disruptions, Schloss built incredible wealth over his investing life. Walter Schloss was an active investor well into his 80s and was known to have outperformed the S&P 500 close to 6% for almost 50 years. Taking a cue from these proven investors during the next market slump, challenge yourself to do the following. Study dividend-paying companies and learn what management is doing to drive the business forward. Look for little to no debt in a company. Buy stock shares discounted to true net worth of company assets for margin of safety. Reinvest dividends to realize the power of compounding. Ignore market disruptions. No investor likes to see red ink in a portfolio, but the successful investors choose to ignore the red ink and mine the market for bargains. It certainly is worth a strong consideration to find discounted value in all market conditions, and any investor working toward this goal using these fundamentals will learn to recognize the true bargains.